Okay, I want to preface this video by acknowledging how many people Dave Ramsey has helped and how many people he's really coached through and gotten out of terrible financial situations. And for that, he is an amazing person. But overall, I don't like Dave Ramsey's approach to 99% of things, and here's why. What's up guys, it's Mateo Hall here. So for those of you who don't know, Dave Ramsey is a financial radio talk show host who preaches about an anti-debt mantra of life. He was in the business of real estate for quite a while. He was doing a lot of short-term deals, leveraging himself to beyond unimaginable extents, and he made a lot of money through that. But unfortunately, Dave Ramsey lost all that money and became bankrupt. The banks called for all of his dues to be done because they were acquired by a larger bank, and they didn't want to keep doing the same risky deals with Dave. So ever since then, he's kind of had a come to Jesus moment and found religion and has been preaching this life of anti-debt ever since. So with the formalities out of the way, I really like debt. One of my first videos I uploaded on this channel is why I'm already in debt at 18 years old. I'll leave a link to that down in the description. Really good video. I'm really proud of that. You guys should check it out. But I subscribe to a little bit of an more anti-Dave Ramsey approach when it comes to debt and a lot of things. So Dave Ramsey will tell you that every type of debt is bad debt, that you shouldn't even get a credit card. Because if you get a credit card, you might have a balance on that credit card, and if you have a balance on that credit card, you're going to be paying interest on that credit card, and thus you're having debt, and you get in this revolving cycle of debt. Now, yeah, that is a great point. If you carry a balance on your credit card, that is an absolutely terrible idea. I 100% agree with Dave on that. More power to you. But that's more of an elementary explanation of what credit cards are, I would argue. If you're smart with your credit card, then you're never going to be carrying a balance on it and you're going to pay it off in full every single month. I personally treat a credit card like I do a debit card. If I don't have the cash to pay for it right now, then I'm not going to put it on my credit card. But since I put it on my credit card, I am then able to get a little bit of cash back, say 2% on every single purchase. If you're spending $1,000 every month and you put that all on your credit card, you're getting a free $20 back. You can go treat yourself to an alright dinner with that. But if you're spending $1,000 every single month and you're only making $900, that's when it starts to become a problem. Because if you're paying $1,000 when you only have $900, you're still running a balance of $100. So yeah, Dave Ramsey is right. If you're irresponsible with your credit card, then you shouldn't have one. But if you know what you're doing, then take out a credit card. It's gonna save you money. He'll argue that credit card companies spend millions upon millions of dollars on the psychology of money in order to get you to actually spend more using their card, which might be true. But the majority of where credit card companies actually get their money through is transaction fees, not the interest occurring. So what a lot of people don't realize is that every time you swipe your MasterCard, swipe your Visa card, swipe your Discover card, Discover, Visa, and MasterCard, they all take a little profit off the top of that. Let me give an example. Say you go over to Walmart and you spend $35 picking up a couple of groceries. You're only paying $35 for that. But Walmart is paying a $5 fee on top of all that. So the actual price of your goods is probably $30, but Walmart is going to throw an additional $5 charge on, evening out among all your items to cover the cost. So if Discover is charging 1.5% extra on every single purchase, the producer is going to bake that into the charge already. So you're paying for other people using credit cards even if you don't have one. If you use cash for absolutely everything, you're still going to be paying that credit card fee because it's baked into the price already. While if you use a credit card, you're going to be getting that money back, canceling out any fee that you're going to be paying. So would you rather pay that extra 1.5% fee, or would you rather get 2% back on your money? Talking about cash versus credit a little bit more, Dave says that you should be spending cash on absolutely everything. That's how you keep a budget. You take $100 with you to the store and you only have that $100. Well, if I take $100 out of my bank account, I don't know where that $100 goes. If I take $100 and I put it on my Capital One card, then I can spend that Capital One card and I can see exactly where every single penny of that goes. Dave will argue that he has the Every Dollar Budget app, but a lot of people don't like budgeting. I made a video on budgeting and people don't want to budget. They want to spend how they do. But if you have a card, if you don't have to write everything in physically, if you can just look at the electronic e-statements on your card, then you can see where every single penny was spent. That's enough about credit cards, Dave. Let's move on to a little bit higher financing. Housing. Now, as you guys probably know by now, I want to become a real estate investor in the next 5 years, and I plan on doing that at a very rapid pace, which is gonna require a lot of debt. Heck, I plan on putting 3.5% down on my first property. Dave would argue that you should be buying your properties absolutely in full. Well, that means I wouldn't be having property for a very long time. See, when you leverage your money using debt to buy a property, that means you can control a really large asset, say $400,000 worth of property, with just $12,000 to begin with. And then you're paying that off in either the next 15 or 30 years. He also says that if you are taking a mortgage, you should put it on a 15-year mortgage and try to pay that off as fast as possible, which I also disagree with. I want to get a little bit of cash flow on my property, so I'm going to put a 30-year mortgage on them. So, hear my logic on this, Dave. If I'm paying $400 on interest every single month, you say that is me burning money, right? As opposed to me paying $1,200 in rent every single month. That's not burning money. See, when I pay the $400 in interest every single month, that means that I'm also paying down part of the principal. Let's say that my payment on both of these properties was $1,200. If I pay $800 in principal and $400 in interest, that really means my effective price of owning that property is $400. Because the other $800 is just going back into principal into that property, and I'm gaining equity in it. That means I can still hold on to that money, it's just in a different place. As opposed to this rental property over here, if I'm paying $1,200 in it, I'm giving that $1,200 to the landlord, who's paying off his principal and interest, or heck, he might even own the property outright, and he's getting that free $1,200 right into his pocket. So I would ask you, would you rather pay $400 for a property that you own, or $1,200 for a property that you get to live in for the next 6 months? Also with leverage, you can own multiple properties with the same amount of money that you would have owning one. Let's go back and say you have that $400,000 house, and you have $400,000. Let's ignore closing costs for the sake of argument right now. So you could buy that house in full right now. That's pretty great. Let's say you get $2,600 in rent each month from that house. So you're getting $2,600 from this one house. Or you could buy 4 $400,000 houses and put 25% down on each house. Now, you're still getting that same $2,600 a month from each house, but you also have to pay a little bit in mortgage expenses. So you're going to be paying $1,300 in mortgage on each of these houses. Okay, that's kind of sucking. It's going to cut into your $2,600 each time. Except if you take that $2,600 times 4 houses, that's $10,400 that you're getting from each property. Minus 13 times 4 is $5,200. So you're still getting $5,200 in net rent from these properties. Granted, you're going to have some maintenance costs and account for vacancies, but maybe that'll come out to another $2,600. You're net even on both these properties now. Except, we're not even counting the tax exemptions yet. This is getting a little bit more in-depth, and I feel like I'm going to make an entire video just on buying a house on its own. But let me just tell you that your tax exemption, just by buying these houses, is going to be well into $40,000. That's through your principal pay down versus interest paid, property tax, maintenance costs. It gives you a huge tax break in the end. And the amount of money that you're going to be saving from taxes just by owning these 4 assets is a lot more than you're going to be making from owning this one asset, even if you own it in full. You don't get really any tax write-offs for owning a property in full, besides property tax. Okay, Dave, now let's talk about the snowball method versus the avalanche method of paying off your debts. So Dave Ramsey will tell you that if you have debts, you should list them smallest to largest and pay off the smallest debt first and go up and pay the minimum payments on all the other ones, because it's psychological. If you really know that you can pay off these debts, then you're going to get it done so much faster. Congratulations, that is awesome. You shouldn't have had these debts in the first place. But that's another thing. Most of these debts are going to be through credit cards. Perhaps you'll have a student loan debt in there too, and I'd agree with this to a point. If you have a $50 debt, just get rid of that thing. But why are you going to pay down three $200 debts at 4% when you have a $2,000 debt at 14%? Pay off that 14% debt. Dave admits to himself that the math works out. I'm a math person, he's a math person. He says that the psychology of money is more powerful than the math of money. I would disagree with that. I would rather save the money by paying off that 14% loan so that it's not accruing even more interest than get the psychology of paying down $200. Now, that's not to discredit and say that this is a terrible method. You should never pay down your small debts first, because for some people, you do need that psychological boost. But if you're able to separate your emotions from the money for a second and look at it logically, run the numbers. See how much interest you're going to be paying if you're paying all these small debts down first and then that big one. Granted, if you were able to separate yourself from the money, you probably wouldn't have been in this much debt in the first place, but that's a different issue. Now, since Dave Ramsey loves looking at psychology, I want to look at the psychology of Dave Ramsey a little bit here. Why doesn't he like debt? What was that big catalyst that brought him down? Yes, he went bankrupt, but where did he go wrong when I'm saying that I wouldn't? So the problem that Dave Ramsey was making is that he was taking out short-term loans that he wouldn't be able to pay off when the loan came due, guaranteed. 30 to 80-day loans doing a flip on a renovation is extremely risky, because you're hoping that if you can't get that renovation done, then the bank will renew your loan. I wouldn't want to be in the case scenario if that renovation wasn't done yet and you hadn't sold. That would suck. That would cause you to go bankrupt. So looking into what Dave Ramsey was doing, that's exactly what he was doing. He was doing short-term loans and refinancing them at the very end, trying to renegotiate terms. And that worked for a while, until the bank was bought up by new partners and the new partners didn't want to continue doing business that way. So Dave Ramsey's been burned by debt really hard, because he made a mistake with it. That's something I will agree with him on. Don't ever take out a debt that you can't pay for. Don't take out a line of credit on your credit card if you're not going to be able to pay it off right now. Don't finance that house if it's going to cost more than a third of your income. Okay, don't tell him that I said this, but don't finance a car. That's just stupid. You're financing a depreciating asset. Do not finance a car, for goodness sake. The second you drive that thing off the lot, I agree with Dave Ramsey, the second you drive that thing off the lot, it loses value. And you're taking out a loan on something that's losing value. When you take out a loan on real estate, it's appreciating in value every single day, and you're making more money just by owning that asset. When you take out a loan on your little Dodge, and then a year later it's worth 20% less, what are you thinking? Get rid of that thing, buy a car that you can own now. I really do like Dave Ramsey. I've been listening to him for a really long time, and I agree with some of the things that he says. But I think that what he is teaching is an elementary school level of understanding of finance. People who have got themselves in a really bad situation and need to get out of it. I agree that if you're in this situation that you can't handle your money, which if you're $100,000 in debt on credit cards, then you obviously can't handle your money, that you should probably listen to him. But if you have the slightest idea on how to handle your money, if you can have the willpower to pay off your credit cards and know when to use them, then it's kind of a waste of advice, Dave. Manage your assets carefully and use debt to your advantage, especially when you're in the growing stage of building your wealth. Once you're as rich as Dave, that's when you can start buying properties in full, because you're more in a conservation stage. I'd like to thank Dave for all the help that he has done to hundreds, thousands of people out there. he has so many more subscribers than me. He's been on this earth so much longer than me. And I would love to have an actual dialogue with him that we're not arguing with each other, but kind of trying to understand it more. He has a lot of good points, but I don't think that mathematically it always works out, and even the psychology of it doesn't really help. I think that Dave was burned by debt in a really bad way, and he doesn't want to see anyone like that, which is admirable, but when you know what you're doing, debt can be used to your advantage a lot more than it would hurt you. Thank you guys so much for watching. Remember to leave a like and subscribe to the channel. I'm uploading 2 videos a week now, and I'm really keeping strong on the schedule, so it would help me so much if you guys were to subscribe and leave a like to know that you're actually watching to the end here. And if you did watch all the way to the end, then check out the description down below. There's a link to Robinhood, which just by creating an account, you get a free stock. And there's a link to my Webull, which if you deposit $100 in their trading platform, they're going to give you 2 free stocks valued anywhere between $800 and $1,600. And if you haven't already, sign up for the Discover card. You'll get $50 just for signing up if you're approved for the card. Remember, only spend on the card if you can afford it. I'll see you guys next time until we continue our financial journeys.